You've heard about the stock market gains in hot areas like AI, but quietly, some Canadian investors have seen positive returns from some good old-fashioned sectors: banks, miners, energy giants. Coming up, we'll break down what happened and how it could benefit your portfolio. So let's dive in to this week's market moves. All right, first, the setup. If you've been reading the headlines, you might have reasons to conclude Canada's economy is under pressure: trade uncertainty, housing headaches, and cash-strapped consumers. But in the stock market, Canada's been red hot. In the past 2 years, the benchmark TSX index has outpaced the much-talked-about S&P 500, even more so when you measure it through total return, which includes dividends. So who's been doing the heavy lifting? It comes down to what's actually inside the index. Canada is dominated by traditional sectors. Financials make up more than a third of the market. Add in energy and materials, and nearly 70% of the TSX is basically banks, insurers, pipelines, oil, and gold. And again, at a time when there's so much focus on AI growth, many companies in those groups I just mentioned have been crushing it. As an example, Canadian financials in the past 2 years have doubled when you include things like dividends and measure it through total return. Materials, home to the gold and silver miners, are not far behind. And energy, it's had a solid stretch too. Compare that to the S&P 500, where technology alone accounts for about 38% of the index. And when you factor in the big tech names sitting inside communication services and consumer discretionary, the US market is even more tech heavy than that. So these are two very different markets. And in Canada, the old economy has been putting up new economy-like numbers. There's another piece of the story worth knowing about as well. I referenced dividends earlier. According to Bloomberg data, the average dividend yield for a TSX-listed company is roughly double that of the S&P 500. That's actually a good reflection of what's inside each index. Canadian banks and utilities have long histories of paying and growing their dividends. US tech companies, not so much. So how do investors participate? Well, this is not financial advice, but one easy way is to own the broad Canadian market. As an example, Global X offers the Global X S&P TSX 60 Index ETF, ticker CNDX. It provides exposure to 60 of the largest and most liquid companies in the Canadian market by tracking the S&P TSX 60 Index. And for investors who want more targeted exposure, Global X also offers a range of sector-specific ETFs on the Canadian market, including financials, energy, and more. So there are lots of ways to play the Canadian story. You can learn more at globalx.ca. That's it for Market Moves. What market moves are you watching? Let us know in the comments, and make sure to subscribe so you don't miss our next investing video. See you next time.